When it comes to your retirement, there are a lot of things to consider with investments. One of them is the scheduled interest rate hike by the Federal Reserve. Here to tell us a little bit more is Jim Heafner, president of Heafner Financial. He's a certified financial planner and is known as Carolina's retirement coach. Hello, sir. How you doing?
Good morning, Eugene.
Good. You know, when we talk about interest rates and the speculation that they may go up, I always think that they favor the banks. Tell us about the ripple effect and how that affects our investments.
Well, Eugene, remember back in the early 80s when CDs were paying 15%?
Mm-hmm. Yes.
And I saw mortgages as high as 21%, right?
Yep.
Well, what are CDs paying today?
I don't know what
Maybe 2%?
Yeah, they're less.
Not 15, but 2. And what are mortgages today? 3, 4?
3.5%, 4%?
Yeah. Not 21, right?
No, not 21.
So we've been in a declining interest rate environment for the last 40 years.
Okay.
So what that means is that most financial advice out there was developed for an economy for the last 40 years in a declining interest rate environment. We now live in an increasing interest rate environment. It's clear the Fed is committed to making interest rate increases consistently, small ones over time, consistently for many years to come. What that means is your financial advisor has never lived in a time that we're in now with a rising interest rate economy. And your financial plan probably has no design in it for an increasing interest rate economy. So if you think about it, the bonds are the most vulnerable tool to interest rates. Now, over the last 40 years, bonds made money because as interest rates fall, bonds rise in value. So your bond became very popular over the last 40 years. People wanted to buy that bond. As we go into interest rates rising, bonds fall in value. So what you've been told is your stability, and bonds are less volatile than stocks, but they're not safe, and you can count on losing money as you go forward if you're in bonds.
Okay, well, let's help me out and help all our viewers out. Let's explain the difference between a bond and a bond fund. Because I was always told when we had buy savings bonds, buy bonds when you were a kid in the 70s, 80s. I've always heard that. So what is the difference between bond and bond funds?
Right. So a big difference here. So with a bond, you're actually loaning money to a corporation or a government entity, and that company is going to promise to pay you back at the maturity date, which could be 10 years out, 20 years out, 30 years out.
Yeah.
And as long as you hold to them, and as long as they can pay you back, and sometimes they go bankrupt and can't, but as long as you hold to them and they can pay you back, you get your money back, right? Now, if you sell early, you're selling on the market and you get what you get, which in the last 40 years could be making money, now probably losing money.
Losing money.
Right. But bond funds are different. Bond funds have no maturity date.
Okay.
Right. So you're selling always on the open market, getting what you get. Today, with an increasing interest rate environment, whenever you sell, you're probably going to lose money in bond funds. There is no guarantee to get your money back in bond funds.
So if that's the case, is there a purpose or any scenario we can see having bond funds in our portfolio?
Well, also another good question. Well, again, bond funds provide, or bonds, either one provides less volatility in our accounts. And we like that, especially as we get older, we tend to move money from stocks, from equities, into bonds because bonds are less volatile. The problem is you're going to lose money. So is it worth losing maybe 20, 30, 40% of your value in bonds to provide some stability? I don't think so.
I don't think so either. Oh, no. So with that, how do you mitigate against that problem with the bonds? If we know they may be detrimental to your portfolio a little bit, how do you mitigate it, especially with interest rates rising?
Well, you know, the problem is people really haven't adapted yet to that. This is a different economy than we have been in.
Gotcha, sir.
And all financial advice that we're used to getting is designed for the old economy, not the new one. So one, you want to recognize that there is a different economy to deal with. We need different solutions. And that bonds have this interest rate risk, which is going to hurt us if we are in them. So ask your financial advisor for a bond alternative. What can I do to make that 3, 4, 5, 6, 7% a year, or that income that I need to retire with, where I can't lose it to the market like I will in bonds?
You need someone like Jim. Retirement planning can be so complicated, so it's so important to sit down with a trusted financial professional like my man Jim. Give Heafner Financial a call. The first 5 qualified callers will receive a complimentary, no obligation financial review. The number is 704-552 1230. You must have a minimum of $500,000 in investable assets to qualify. Again, that number is 704-552-1230. And you can also visit Jim's website. It's you'lljustknow.com. I like the way that you'lljustknow.com. Thank you, Jim Heafner. We really appreciate you.